From buying groceries to gasoline to automobiles, inflation has hammered Americans' purchasing power. In fact, the most well-known metric of inflation has soared to a 4-decade high. Watch this video till the end to know how you can tackle this and come out of inflation wealthier. Hey guys, welcome back to the Ring of Knowledge, your trusted source of practical financial knowledge for a wealthy lifestyle. Inflation possesses a lot of problems in our daily lives, but problems are also seen as opportunities. You need to make profits in difficult times to thrive in the good or average market. So, in today's episode, we're going to learn how to make money during inflation. Before moving on, subscribe to the channel and smash that like button. So, without wasting much time, let's get started. Inflation remained low following the Great Recession as the financial system recovered. Inflation never surpassed 2% for numerous years. However, inflation has made a comeback in recent months. President Biden has described this period as transitory, but many people are concerned that inflation is here to stay. For those who have no idea about inflation and who haven't watched our previous video, we'll like to explain to them about inflation in simple terms. So, what exactly is inflation? If you've noticed that the trip you want to book for a forthcoming holiday is more expensive than last year, or that your grocery bill has increased despite the fact that you're buying the same amount of food, you're witnessing the effects of the country's current inflation boom. While prices for products and services continue to rise, the more painful element for consumers is that we don't know how long it will persist or how we should react financially. For the average consumer, higher prices might imply restricting any splurge spending to avoid a significant knock to your pocketbook. However, if you invest, you're probably more concerned about your money losing value in the market. Inflation has fluctuated throughout history. Prices rose 10% to 15% in certain years during the 1970s and 1980s. Inflation has since moderated. Inflation rates in the 2000s ranged between 2 and 5%, whereas inflation in the 2010s was between 0 and 2%. In other words, relative to other periods in history, prices have remained remarkably constant in recent years. Inflation, on the other hand, has recently returned to the discussion. Inflation was 5.4% in the 12 months ending in July 2021, one of the highest rates in several years. To tackle all this and stay ahead of the curve, here are the best inflation hedges to consider if you want to stay afloat as prices rise. Commodities. When inflation begins to climb, investors frequently resort to physical assets that are likely to appreciate in value. For millennia, gold and, to a lesser extent, other precious metals have served as safe havens, prompting prices to rise when inflation rises. Gold can also be purchased directly from a bullion or coin dealer, or indirectly by investing in a gold-related mutual fund or exchange-traded fund. Investors can also gain exposure to a commodity by directly or indirectly purchasing the shares of its producers through an ETF or specialist mutual fund. Raw minerals and agricultural products such as oil, copper, cotton, soybeans, and orange juice are examples of commodities. In inflationary conditions, commodity prices tend to grow in tandem with the pricing of finished goods derived from those commodities. Higher crude prices, for example, raise the cost of fuel and transportation. Commodity futures and producer shares can be traded by sophisticated investors. Exchange-traded funds that invest in commodity futures, on the other hand, tend to underperform growing commodity prices since their futures positions must be rolled when they expire. Properties and rentals. Real estate is a popular investment because it serves as a more useful and popular store of value during times of inflation while also delivering greater rental revenue. Real estate can be purchased directly by investors or indirectly through the purchase of shares in a real estate investment trust or specialized fund. During a period of sustained inflation in the 1970s, real estate performed extremely well. However, as shown in 2007 and 2008, real estate is sensitive to rising interest rates and financial crises, and raising interest rates in the traditional monetary policy response to rising inflation. Precious metals and gold. Gold has long been the classic investment to protect against inflation. Gold is a tangible asset that tends to keep its value, whereas financial assets may lose value owing to a reduction in buying power. Gold sold for $1,077 per ounce in August 2018. By March 2022, it had risen to more than $2,000 per ounce. Stocks of high value. According to some data, value equities outperform growth companies during periods of inflation. Companies with high earnings relative to their present share price are considered value stocks. They are also known for having strong cash flows, which investors value when prices are rising. Growth stocks, on the other hand, are more susceptible to interest rate fluctuations, which are a usual monetary policy reaction to inflation, growth stocks had a great run during the last decade, while inflation was glaringly absent. However, value stocks have recently made a resurgence. The current atmosphere bodes well for their continued growth. Bonds. During inflationary situations, U.S. savings bonds become attractive investments. Despite the fact that they can only be purchased for $10,000 per year and are classified as non-marketable securities, I-bonds promise to keep up with inflation. They, like TIPS, provide a practically assured return of principal. Investing in I-bonds will not yield extraordinary returns, but it will preserve purchasing power for a portion of your portfolio. Given that many investments such as cash and long-term bonds are expected to lose real value during inflationary periods, it makes sense to consider alternatives to equities that have a chance of staying up. Cash. Cash is often overlooked as an inflation hedge, says Arnott. While cash isn't a growth asset, it will usually keep up with inflation in normal terms if inflation is accompanied by rising short-term interest rates, she adds. Anna Nije-Conti, a CFP and founder of Dare to Dream Financial Planning, agrees. With the pandemic proving just how unpredictable the economy can be, Nije-Conti suggests always keeping some cash in a high-yield savings account, money market account, or CD. Having too much cash is an underestimated risk for individuals' finances, she adds. Nije-Conti recommends setting aside 6 to 9 months for single-income households and 6 months of cash for two-income households. Lassus recommends keeping your short-term CDs until we have a better idea of what longer-term inflation might look like. TIPS. TIPS is an abbreviation for Treasury Inflation-Protected Securities. TIPS, while appearing to be a mouthful, are actually fairly simple to understand. TIPS are government bonds that move in lockstep with inflation. As a result, when inflation rises, so does the interest rate paid. When there is deflation, interest rates fall. Because TIPS are indexed to inflation, they can help balance out your fixed income or bond portfolio, explains Diahan Lassus, CFP and managing principal of PPAC Private Wealth Management. It's one of the safest investments for your money because they are backed by the federal government of the United States. They are also an excellent strategy to diversify your investments while augmenting potential retirement income. TIPS can protect against unexpected jumps from inflation because their price moves in pace with the Consumer Price Index, says Amy Arnott, a Morningstar portfolio consultant. By far the strongest inflation hedge for the average investor, she says. TIPS bonds pay fixed-rate interest twice a year and are available in 5, 10, and 30-year maturities. At maturity, investors are paid the greater of the adjusted principal or the original principal. Debt obligations loans. Leveraged loans can also act as inflation hedges. They are a floating rate product, which means that banks or other lenders can boost the interest rate paid to keep up with inflation. Mortgage-backed securities and collateralized debt obligations, which are structured pools of mortgages and consumer loans, are further options. Investors do not hold the debts directly, but rather invest in securities with loans as underlying assets. MBS, CDOs, and leveraged loans are sophisticated, somewhat dangerous securities that frequently have relatively substantial minimum investments. The most practical option for most retail investors is to purchase a mutual fund or ETF that specializes in these income-generating products. Cryptocurrency. Bitcoin is frequently referred to as digital gold, and due to its restricted supply, it should protect against inflation. However, the jury is yet out on whether it will be a good long-term inflation hedge, Arnott argues. Arnott also mentions Bitcoin's recent volatility as a caution to investors. If anything, she believes it underlines the difficulty of incorporating Bitcoin into a diverse portfolio. Traditional financial service providers, such as Cash App, PayPal, Robinhood, and SoFi, have developed apps that make it simple for average users to buy in cryptocurrency. The benefits and drawbacks of investing for inflation. Every sort of investment hedging has advantages and disadvantages, just like every other type of investment. Additionally, the numerous assets outlined above have both good and negative characteristics. The primary advantage of investing during inflation is, of course, that your portfolio's value is preserved. The second reason is that you want your nest egg to expand. It can also lead to diversification, which is always a good thing to think about. Spreading risk across multiple holdings is a time-honored strategy of portfolio construction that is equally useful to inflation fighting as it is to asset growth strategies. Pros. Inflation that is low and consistent might be an indicator of a flourishing economy. It's advantageous to holders of fixed-rate debt, such as mortgages. It promotes consumption now rather than later. Cons. Inflation diminishes purchasing power since each dollar purchases fewer products. Price increases across the economy harm retail consumers. It's detrimental to pensioners on fixed incomes. It prompts the Federal Reserve to act. Inflation is a chance. Because it occurs with or without our will, consider inflation inflation an opportunity to reassess your entire portfolio. Even though inflation has just risen, interest rates remained near record lows in August 2021. One of the most effective methods to prevent inflation is to have a well-diversified and fully invested portfolio. In the long run, money invested in equities tends to beat inflation, but positions in real estate, commodities, tips, or I-bonds can merely provide further diversification. Cash on the sidelines will always lose value, while long-term bonds will suffer if interest rates begin to climb. In general, inflationary periods provide an opportunity to review your financial condition and make adjustments for what lies ahead. That's it for the video, guys. Hope this video provided great info. Press that like button if it did. Comment down which inflation you consider the best. Share the content to spread the good info. Subscribe to Ring of Knowledge for more amazing and helpful finance content that will put you ahead of the world. Peace out.